So here is the question. Jerome Powell came out, right? He said, we're going to raise rates 3 times in 2022. Inflation hit 6.8%, highest in 40 years. The question is, what is the best portfolio for increasing federal funds rates for an inflation above 6.8%? I'm going to show you exactly what has worked in the past in all the assets, stocks, bonds, commodities. We're going to look at all of it to see exactly what does best when the federal funds rate goes up and when inflation's high. Stick around. All right, hey everyone, this is RC Peck with Fearless Wealth, and we have to talk about the federal funds rate today, but not that specifically, more what assets do best, what symbols do best, what investments do best. And this is important for everyone, whether you're 30 years old or 50 or 80, because we are moving into an environment where the federal, I'm gonna say the federal government, that's a slip, where the Fed, our central bank, the US central bank, is increasing their rates, and they said they're going to increase them at least 3 times in 2022, and we're just about to get into 2022. So this is a very timely topic, and I'm going to jump over to the charts and let's get into this. Okay. I want you to just look at the price chart here. There are 2 charts. The top one is an index, and I'm going to show you a bunch of different indexes. And the bottom one is when the Fed has increased rates. So if you look at the bottom chart, when that line goes down, that means the Fed is dropping their rates. And when that line goes up, that means the Fed is increasing the rates. Obviously, there's periods of time where the Fed kept their rates flat. You can see that between 2009 and almost 2016. The conversation today is what happens when the Fed increases rates. So the bottom part is the federal funds rate. Okay, goes from 0 up to 6.5%. And then the top chart's going to be whatever index we're looking at. Now, in this case, this top chart is the S&P 500. So let's kind of just go through here, and we're going to do this with a bunch and just kind of say when the Fed increases rates, here they increased it in 94, and the stock market basically just went 0. Maybe slightly up, but we're going to call it slightly up to 0. So 1, we'll call it maybe neutral or neutral plus. The second time the stock market went up, so the second time the Fed increased rates, the market went up. The third time the Fed increased rates, the market went up. So now we've got 3 times. The fourth time the Fed increased rates, the stock market went up. This is the US stock market. So we have data going back 30 years. 4 times the Fed increased rates, and of those 4 times, 1 was neutral, 3, the stock market went up. Okay, let's do this. Let's go look at the Nasdaq 100. Just a different part of the US stock market. Same thing, we're going to look at the exact same time periods every time. First time, positive. Second time the Fed increases rates, positive. Third time, positive. Fourth time, positive. So with the Nasdaq 100, all 4 times the Fed increased rates over the last 30 years, the Nasdaq 100 went up. I don't know, everyone, if it's going to happen this time, but we have to understand what happened in the past. And those are very different market conditions, right? We have the market condition after the last 12 years, right? The global financial crisis, and we had everything that happened before that. Okay, I want to also show MS World. So I want to show all world, ex-US, MS World. So this is basically an international index here. This is it's the whole world minus the US. The MS World Index, at least on stock charts, only goes back to 1995. So we're only going to be able to see 3 on here. So here, 1 of the 3, international went up. The second one, the Fed increased rates, international went up. And the third one, drum roll, slightly went up. It was very... If you look at the top part of those 2 blue lines, the top chart is MS World. It did go up, but it first fell, then went up, then fell, then went up, then came down. Like, it was pretty messy for international. So international it's a slightly different answer now, right? Because of the 3 we can track on the price charts, 2 looked great, 1 didn't. And the one that didn't is the most recent one. So that's a little concerning for international, right? Because the most recent one's always the most important. The most current part of the chart's always the most important. Okay, and then I want to show one more part of the world. Let's show Emerging markets. So emerging market, the MSCI Emerging Markets Free Index. These are all indexes I've shown you. We're only going to be able to show 3 here because of how far back the index goes. So emerging markets did well the first time, at least what we can track on here, when the Fed increased rates in the late 90s. And then between 04 and 06, emerging markets did well. And then the most recent time the Fed increased rates, it's not as beautiful as the Nasdaq or the S&P, but it definitely is better than all world ex-US. But it's not as clean as the other ones. So again, which makes sense because emerging markets is also part of international. So from a stock point of view, from an equity point of view, let's just talk about what's happening. US equities, at least historically, I shouldn't even say at least, over the last 30 years, the last 4 times the Fed has increased rates, they liked it. They probably read saying, hey, the Fed's increasing rates, things must be good. Let's do that. Now, how will this one be when they cut back buying treasuries or mortgage-backed securities? Every time it's always slightly different. And that's true with every time the Fed increased rates over the last 30 years. It's always been different situations. So let's kind of stay a little high level here. Okay, next let's go to gold. Okay, so we thankfully have gold going back. So the first time the Fed, at least over the last 30 years, raised rates was in the 90s, and gold was slightly up. I mean, slightly up, flat to slightly up. The second time, it was flat to slightly down. So let's just, for easy math, call those 2 neutrals. The third time, gold was up, and the fourth time, gold was... Gold's a mixed bag here. I mean, it was slightly up here, but very, very, very messy. So gold, I would say, is a flip of a coin. We just don't know. We have 2 neutral. One was neutral, slightly positive. One was neutral, slightly negative. One was clearly up. One was like close to that messy neutral. So gold is a flip. You would not want to be moving to gold just because the Fed is increasing rates. Now, I also want to look at just the overall commodity market here, and this is the CRB Index, the Reuters-Jeffrey CRB Index. So this is all commodities. And let's go through the same 4 periods. So the first time, commodities liked it. The second time the Fed increased rates, commodities liked it. The third time the Fed increased rates, commodities liked it. And the fourth time the Fed increased rates, commodities did not like it. And that's the most recent one. So this is kind of a mixed bag too, because if you remember just 2 minutes ago, I talked about the most recent kind of correlation is the strongest. And the most recent one is out of the 4, sideways to down. And that's what we have here with commodities. So commodities is not giving us a clear signal. I've talked about commodities many times, and I said, as long as the CRB index is above that blue line or that blue area, then you either have to be neutral or bullish. Now, this time we have the Fed increasing rates with pretty high inflation. So every situation is different. And so having that inflationary pressure could quite possibly help the CRB. Okay, so we did markets around the world, we did 2 commodities, and then let me just show a couple things. And this is something that is really important. So let me just show you U.S. Treasuries 5-year. So this is the yield. This is the yield on a 5-year Treasury. And then I'm going to show you a 20-year Treasury. And this is really important because I'm using 5 because let's still consider that short term. So the yield on the 5-year Treasury went up the last time. Kind of makes sense. Not the last time, the first time. The second time the Fed did it, 5-year yields went up. The third time the Fed increased rates, 5-year yields went up. And then the fourth time the Fed increased rates, the 5-year yield went up. Now here's what's interesting. The 5-year yield is already spiking higher. The Fed has not increased rates yet. So this will be interesting to see that if all of this is getting priced in on the front end, and by the time they actually start increasing rates, the rates will already be priced into shorter term treasuries. Let's compare this to 20 years. Because I think, let's just see. So here's the yield on the 20-year when the Fed increased rates in the mid-90s, went up when the Fed increased rates in the late 90s, went up but not that much. Third time between 04 and 06, flat to down. It's actually down. And then the fourth time the Fed increased rates was messy, but ultimately higher. So the long end of the Treasury is very different, right? So remember when yields go up, the price of those bonds go down. So bond prices are going to be under pressure, but the ones that are most under pressure are going to be short-term bonds and not necessarily long-term bonds. Long-term bonds are kind of a mixed bag. Sometimes they're flat, sometimes they went up. But just know that the short-term bond prices are going to have much more pressure on them than long-term bonds. And this is important because if you're looking to position your bond portfolio, this is what we're talking about. How do you position your portfolio? You'd want longer-term bonds, all things being equal. Tips don't go back. I don't have an index for the tips. One would believe, and actually, let me just bring up the tips. The tips don't go far. Tips are inflation-protected treasuries. So they only go back 15 or 16 years, I guess maybe 17 years. But we at least have two times where when the Fed increased rates in the middle of the aughts, inflation-protected treasuries went up. And when the Fed increased rates between 15 and 19, 2015, 2019, I mean, look, they did go up, but and just so you know, I'm looking at the top price chart when I do this. That's the price of inflation-protected treasuries. It was pretty much flat the whole time, but it was flat in the middle. It clearly did go higher. And so that is one way to protect a bond portfolio, is to be in inflation-protected treasuries. Let me just see how long MUB goes back. See, we only get one increase for more for municipal bonds. I mean, the one we can show, it does go higher, but still, it's 1 out of 4. It clearly has gone higher. Okay, so let's do this. Let's pull everything together here. The Fed is increasing rates. They said they're going to probably increase at least 3 times in 2022. The question is what assets, what symbols, what positions do best? We looked at stocks. We looked at commodities. We looked at interest rates. The big takeaway is short-term interest rates, the yield goes up. That means the price goes down. So if you're going to be in bonds, you want to be in those longer-term bonds, right? A tracking symbol like TLT, that would help your bond portfolio, or like a TIP, that's inflation-protected treasuries. As far as commodities, gold is not going to help. Commodities overall, much better hedge against inflation than gold itself. And then lastly, we looked at equities, looked at U.S. equities, both the Nasdaq 100, the S&P 500. We looked at international, and we looked at emerging markets. And emerging markets were slightly better than all world ex-US. All world ex-US was not good. International did not do well when the U.S. raises rates. So this is going to be another kind of one of those things where the U.S. may have a leg up on everyone else again. And if you're choosing between the S&P 500 or the Nasdaq 100, the Nasdaq 100 actually has the better history with federal funds rates increasing. Woo, okay, that was a lot to get through. I wanted to get this information to you without, hopefully, not overwhelming. I appreciate you all being in my world, watching my videos, clicking the like button, leaving a comment. We're getting close to the last weekly video of the year, though I think there's 1 or 2 more weeks left. I appreciate you being in my world. I love when you leave comments and you hit the like button. Those things really do matter. So everyone that does that, I appreciate you. And of course, if you like this video, you will love our other videos. And leave a comment what you want me to check out. And let me know where I'm right or where I'm wrong. Okay, thanks everyone. I will see you on the next video. Okay, bye.